right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How are you?
I'm doing well. How about you?
Beautiful day here. It's sunny and it's daylight savings time tomorrow, so I'm a happy guy.
Yeah, that's nice. I heard you were at an interesting event yesterday. You want to tell us about it?
Well, I'm on the board of a wonderful organization called the Museum of American Finance, and basically it's probably one of the largest collections of financial memorabilia in the United States. I mean, this collection owns Alexander Hamilton's original papers, many of them, and the history of finance in the United States. And it's about really educating people about the history of how important financial markets are in the United States. We had our annual gala to raise some money. We raised $1.5 million, and I gave a few Lifetime Achievement Awards out to a couple of important people. Howard Marks, one of the people I greatly admire. He's the head of Oaktree, a very famous investor. I would encourage you to go to Oaktree Capital and read some of Howard Marks' famous memos about the stock market. They're wonderful and have helped me a lot over the last 30 years. So I gave him a Lifetime Achievement Award. He's a very famous value investor. Chuck Royce was there. You can look him up, very famous value investor. These people are legends in the investing community. So if you ever want to learn from the right kind of people, those are the people to learn from. And I get a lot out of being on the board of the Museum of American Finance. It was a great evening. It was done at the old Ziegfeld Follies Theater on 54th Street. This was the original Ziegfeld Theater in the 1920s. It's been completely repurposed and reconditioned, but it's quite beautiful.
Yeah, that sounds like a really great event. I'm glad you were able to go and attend, and thanks for sharing that with us. So Bob, first up, let's just kind of set the lay of the land. Where do stocks stand right now?
Well, we're at new highs. The major indices are the S&P and the NASDAQ. Tech is leading, not surprisingly. Apple is not. It's down about 10%. It's the one laggard out there along with Tesla. But given what Apple has done over the years, it may not be surprising, given the fact that China is slowing down, and China is a significant part of Apple's numbers. China is in the business of sort of purging the country to a certain extent of American influences, and that may include Apple. So they may have to take quite a hit here. We don't know exactly, but sales were down in China recently. But other than that, tech's leading. There's a couple of very good things that are happening. Bond yields have been trending lower for the last couple of weeks. That's a very good sign. If there was a grave concern that inflation was going to remain really high, that would be prevalent there, but it's not. The Fed, we heard Powell this week, they're signaling they're making progress on inflation. They are not ready to cut interest rates yet. So all that was a little bit premature, but they'll probably be cutting by maybe not, maybe May, maybe not, but in the second half of the year, there'll probably be several interest rate cuts. What else? The economy is slowing, but it's not going into a recession. It's still pretty strong. We saw that today with the jobs report. The headline number was stronger than expected, but we had downward revisions in prior months. And this is part of the problem with this game. These revisions downward were quite substantial in December and January. So why do we like that? Well, we want to see the economy slowing down a little bit, but not too much, because that's the name of the game. If it doesn't slow down, inflation stays high, the Fed keeps raising rates. You don't want that. So these were just the right numbers. We call them Goldilocks. It's an overused word, but it indicates that the soft landing is very real. Slow down, but no recession. And that's why we're hitting new highs. That and the combination of this AI story that keeps powering technology stocks this year. But other things are up as well this year. I wouldn't say there's a dramatic broadening of the stock market, but it's doing fine right now.
So next up, let's zoom in on one bank that we've been hearing a lot about recently, which is NYCB. What's been happening with NYCB recently, Bob?
Well, that's the New York Community Bank. They've been under pressure. Look, all of these banks have some pressure from commercial real estate. loans. And the question is, what kind of real estate loans do you have here? If you are big, Class B office buildings in major centers in the United States, that's a little bit of a problem right now. So they've had some issues with that. They reported a big, $240 million loss in their recent earnings report, primarily because they were investing in office buildings and apartment buildings. So they have had several leadership changes recently, but the biggest thing that happened this week is they announced $1 billion capital investment, which is a lot. The majority of the investment, about half of it, was from former Treasury Secretary Steve Mnuchin's fund, which is a Liberty Capital. The remaining funds are provided by other kinds of private investors. Hudson Bay, Citadel was an investor. So it's a real lifeline for them at this point. And I think the fact that it was Steve Mnuchin's firm lended a lot of credibility. That stock was heading down to $1 earlier this week, and it bounced back. Now it's $3 and change, so I don't want to overplay this story, but I think him going on the board with an announcement like that provided a lot of credibility and stability. Now you can argue about whether or not they had to float a lot of new stock to do this, so there's some significant dilution going on here, but this is what they needed to do. And you don't want to have another bank run. Unfortunately, this is the way this game works these days. We've got a major event here. We're going to have to figure out a way. We're going to have to figure out what to do with this excess of commercial real estate that we had. And what's going to happen is some of this is going to be torn down. Some of it's going to be repurposed for apartment buildings. And we're going to have to figure this out in the next few years. It's fine. The country can handle this as long as it's done in an orderly fashion. And that's why I kind of supported what happened here. You can see if you're an investor in New York Community Bank, what happened. It was a bit of a mess, but at least there was no mass panic once it was announced a major capital infusion. So generally, I think that news this was positive.
So, Bob, we are in an election year. So how will the election impact market volatility this year?
Well, I know people don't like to hear this because they somehow think that a Republican or Democratic president will help or hurt the economy or the stock market. Generally, the stock market tends to do fine under Republican or Democratic presidents. There are occasionally times where if you have a major change in the tax code, under one administration, it can have an influence. That happened under the Trump administration in the first, when he was president, there was a change in the corporate tax code and that helped. And other than that, the major thing is simply the fact that the United States is largely a capitalist economy with a very well-known court system. Means of production is mostly in private hands, and it's really the profit motive that motivates it, and whether the economy is growing or not. Presidents have remarkably little influence on all this. Now, in an election year, there has been some studies that shown that when there is a sitting president running, they can pull certain levers that have modest impacts on the economy. And so the stock market tends to do well in a presidential year where the sitting president is running, because whatever little levers they can pull, they'll try to pull them. That makes some sense, but don't kid yourself. What can actually be done is very limited. The president does not control the U.S. economy. That's just wrong. So I would say right now that we are hitting new highs, not because of a presidential election. We are hitting new highs because there is a soft landing scenario. Inflation is not out of control. And there's an artificial intelligence story that is dominating the stock market. Those are the things that really matter right now.
Yeah, well, we'll definitely see how things play out over the coming months. Next up, Bob, is something that I know you and I have spoken a lot about. I know that you've written a lot about, but why is it so hard to pick stocks?
Well, it's hard because the world has become very professional, and you're competing against professional people primarily, not amateurs. I know retail people like to think that somehow there's a whole pool of retail people they're all competing against, but most of the stock market, most of the trading is done by professionals, and they all have access to the same information. And you have no informational advantage trading against those people at all. So I did a report this week, and you can go on Trader Talk and see it, tradertalk.cnbc.com, where the annual scorecard came out from S&P, which was it's called SPIVA. It's a study of how active fund managers do against their benchmarks. So big cap fund managers who pick stocks, they're benchmarked against the S&P 500. And once again, the report came out, and the majority of large cap fund managers underperformed the S&P last year, 60% underperformed. Now, that sounds pretty bad, but actually that's better than it usually is, usually more underperform. But the long-term averages are just dismal. So after 1 year, last year, 60% underperformed. After 5 years, 80% of all stock pickers, active fund managers, underperformed their benchmark. After 10 years, almost 90%. Now think about that. If you hold the fund for 10 years and it exists for 10 years, 90% chance you're going to underperform the stock. It would have been better for you to own the S&P 500. I mean, think about that. That's really remarkable. That's because these fund managers charge fees that eat into the performance they have. So even if they happen to be lucky enough to outperform, the fees that they charge eat into that return overall. So that's a major problem for these people. So the active fund managers have a very, very tough time of it. And you might ask yourself, why does this happen? Why do these fund managers underperform? And there's three things that happen here. The first, as I mentioned, is the market is largely composed of professionals. So there's no informational advantage. The second thing is the fees that are charged. Active managers' fees are higher than index fees, and that fee, extra fee, eats into the return. And then finally, there's the fact that in any given year, only a minority of stocks typically outperform the market. That happened last year with the Magnificent Seven, right? So it's difficult, in fact, it's almost impossible to select what stocks will outperform from 1 year to the next. I know you think you can do it. In hindsight, you think, but you can't in advance. You have absolutely no idea what stocks are going to outperform in 2024. You might say NVIDIA, you don't know that. And the chances are you're going to be wrong. Now, we do have an amazing story with artificial intelligence that is dominant and may dominate for the next couple of years, but don't kid yourself. The persistence of performance, there's no performance persistence that exists out there. So let me give you an example. I said 90% underperform after 10 years. By the way, these studies not only include the fees that are involved, but they look at survivorship bias. More than 30% of the funds that exist go out of business in less than 10 years. And the reason that happens is they suck. They're terrible. They close them because the performance is so poor, people pull money out. So these studies account for what is called the survivorship bias. And the winners survive. And even then they underperform. So here's the snarky answer. I get this all the time from people. Okay, Bob, so suppose you're right. 90% of the funds underperform after 10 years that are still surviving. Why don't we just take the other 10% that are outperforming and let's all just buy them? And I've actually had people say, send me the name of the funds. Here's the problem is, this is annoying. That doesn't work either. And there's a very good reason it doesn't work, because the persistence doesn't continue. Persistence is very fleeting. So, for example, you might have this fund, XYZ fund, was one of the funds that outperformed over a 10-year period. Okay. There is no way for you to know that they'll outperform in the next 10 years. In fact, the evidence is they don't. Persistence, it's called persistence. Can you continue to outperform? Doesn't happen. There's also a separate difference between luck and skill. So it turns out that the data indicates that a good part of the reason that the 10% outperform is just pure luck. You know, the dartboard, the apes throwing the darts at the board. It's just luck. In a certain group of people, you take enough people, and there are thousands of funds that are studied here. A few are going to outperform just by sheer dumb luck. So, and that's very different from skill. So, and this makes it even more difficult to get any kind of persistence going on. So I know you think you can, let's go find those other 10%. But again, if there is no persistence, it doesn't matter. It is really, really rare to get anybody to outperform for even 5 years at this point. So this is why indexing has won out. These studies have been around for a long time, and it was hard to do this up until the birth of the exchange traded fund business. It was hard to own these index funds up until, well, the 1990s, essentially. And after the financial crisis, the ETFs, the indexing became really popular because people began to realize, my God, you know, if I have all of these biases in the way I think about things, and it's hard to pick stocks, the industry exploded in the late 2000s, essentially. So if you're interested in reading the study, it's tradertalk.cnbc.com, and you can look it up.
All right, Bob, and our last question for today, any advice for high schoolers looking to get into finance and anything to avoid?
Well, you know, 30 years ago, people were knocking on the door at the New York Stock Exchange saying, and they'd stop me out front and say, how can I get a job on the floor? And, you know, today they were talking about being in the brokerage business where you're managing what we call the sell side, where you're managing people who want to buy and sell stocks. That business has largely gone away. That business, the floor has changed dramatically. I got there in the mid 90s, there were 4,000 people on the floor, open outcry. Brokers and dealers screaming at each other, brokers and specialists screaming at each other, and they did 80% of the volume on the floor. Today, there's 200, 250 people doing 15 to 20% of the volume. That's technological disruption. That's what happens when you get software and hardware programs that suddenly get created where you can match buy and sell orders electronically without a physical person. That's what happened. And so that end of the business, what we call the sell side, has kind of changed dramatically. There's not a lot of growth there anymore. It's mostly electronic. I'll tell you what is growing in this business is wealth management. So look, there's small groups of people, probably 25, 30% of the population that has most of the stock market wealth in the United States. And the management of that, particularly as people get older, becomes very important. So this is an enormous business now. And companies like Morgan Stanley or Merrill Lynch or Bank of America now have big divisions, wealth management divisions, to advise people, particularly as they get older, about how to handle their money. And it's not just what kind of mutual fund or ETF should I own, but it's general wealth management, a transfer of wealth. Annuities, helping with retirement in general, helping save for your college, for your kids or grandkids. It's advisory business. That business is growing rather dramatically. And you can get degrees now in finance associated with that. There's an area, if you're interested in going into the finance area, wealth management is the business that I would advise people to get into. Think about the baby boom. I'm almost 70. I am the classic baby boomer. And we have issues with healthcare, for example, transferring money to children. And that whole business is enormous. And people need advice, frankly, on what to do. Even if you're a self-directed investor, you say, oh, well, I only own index funds. You'd be surprised how much other stuff you have to figure out in your life. So that would be the area I would advise people to go into.
Great. Well, that's great advice, Bob. And we're going to leave it there. Thank you for answering all of our questions. Thank you to everyone who sent in questions. Feel free to leave a comment if you have any, and we'll get to them next time. And we'll talk again in a few weeks.
Thanks, Katie. Thank you, everybody. Great questions.